For more on the markets right now, we want to bring in Kate Moore. She's the new Chief Investment Officer at Citi Wealth. And Kate, you've been looking at what's happening in the economy. Your perspective is that things were slowing down before this talk of tariffs even came about. So where do you think we stand right now?
Well, let's go back to a year ago, because right about now, as we were going into first quarter reporting, everyone was saying, are there cracks in the consumer? That was the big question. And then the big idea was to pull the worst phrases from every consumer company as they reported first quarter and say, yes, they're there. And as it turns out, the consumer held up pretty well over the course of 2024, but we knew there were challenges. And we're starting to see that a little bit more in the hard data in the beginning of 2025. It's not catastrophic, but it is a real slowing in consumption, and it has been some degradation in sentiment on that side. So I'm watching that very closely as we go into this first quarter's reporting. But I would also suggest that the economy was not perfect at the start of this year.
So, but when we now see some of these reports, there was a recent study, I think yesterday came out, that said the odds of a recession in the United States are now 43% in the next 12 months.
Yeah.
That is a step up. Is that more significant because of tariffs or not? I mean, does the uncertainty cause problems, or do you think this is a temporary pain until you get to maybe some better policy?
So, I mean, the level of recession probability is almost impossible to forecast. I remember having a conversation with a group of economists something like 15 years ago, and we were in, a good economy coming out of some weakness, right? And they said that the probability of a recession over the next 12 months was 25%, that was kind of the baseline. So moving up to 40%, which is what a lot of folks on the street are saying right now, doesn't feel catastrophic. We still have a better chance than not that we're not going to have these 2 quarters consecutive of GDP decline.
We did have really high prices in equities at the start of the year.
We absolutely had high prices in equities at the start of the year and very concentrated positioning. This is something I paid close attention to. Everyone, whether it was U.S. investors, fast money, real money, retail, or international investors, was overweight U.S. stocks. And so there was a lot of space for that kind of rebalancing to happen over the course of this year, and I think that makes sense. But now we're kind of in a settle-in. Let's see what happens to the hard data. Let's see what happens to everyone forecasts, and let's see how companies talk about adjusting their businesses on the basis of policy.
What do you do with your investments in the meantime as you're awaiting all of those?
Yeah, it's uncomfortable to say this, but I would not be putting more money to work in kind of risk assets at this point, so equities or in credit. That doesn't mean sell what you already own. We want to be like medium and longer term investors, but we also want to be taking advantage of tactical opportunities. And I think the equity market is going to be caught in more of a trading range in the near term as both technical pressures and policy fears bounce us around.
What would give you the answers you're looking for if you hear what in earnings season, if you hear what from Washington policy?
Yeah, Becky, I wish I could tell you that there was something great I could hear from earnings season that would give me confidence, but the people running companies are just like you and I, not making the policies themselves, so they're giving us our best guess. I'll tell you what that would make me nervous is if companies are pulling guidance in first quarter earnings, not adjusting lower, that always happens, adjusting lower, adjusting higher. But if they say we actually have no visibility and therefore we can't communicate that to the street, that makes me more nervous because then I think you get more inconsistent spending, hiring, and investing behaviors from those companies. If they say, hey, we're going to adjust down a little bit, then you can project. It's that level of kind of black box thinking that would make you nervous.
Okay, that's really interesting.
Yeah.
Hold off, see what comes. Be aware of some of these warning signs.
Yeah, be patient. We're going to get a good bite at the apple where we'll look at high-quality companies where we have, great faith in where their earnings are going over the next couple quarters. And we'll say this is a long-term secular theme. We have a good entry point, and we'll be able to add.